Welcome to a new episode of Inside the Economist's Mind. Today we're doing a deep dive into the May 2025 ING monthly economic update. You know that feeling when the global economy just feels, well, a bit stuck, like a deer in the headlights, sort of frozen, unsure which way to turn? Our goal today is really to unpack the crucial economic signals, the forecasts from ING's latest analysis. Think of this as your shortcut to understanding what's actually happening. We're drawing from their reports, focusing on global trade, monetary policy, and the different outlooks for various regions. We want to pull out the most important insights so you can quickly get a handle on this, evolving economic landscape.
That's a really good analogy, the deer in the headlights. This report definitely captures that sense of the global economy trying to navigate some pretty tricky terrain. What's striking is how many different potential bumps in the road are feeding into this uncertainty.
Okay, let's dig into that analogy a bit more, this deer in the headlights thing. What are the specific economic shocks the report points to? What's causing this global pause?
Well, there are a few key things, really. Those tariff increases from April, they're still casting a pretty long shadow. Businesses are still trying to work out the full impact. Then, of course, the ongoing war in Ukraine continues to be a source of instability, affects supply chains, overall confidence. And maybe closer to home for some listeners, there are these background questions about the stability of U.S. public institutions that just adds another layer of complexity.
It's interesting, though, because on the surface, markets, well, they seem to have calmed down a bit recently.
Yeah.
But the report warns against reading too much into that, right? Not seeing it as a return to normal.
Precisely, yeah. It's probably more like a temporary lull. The underlying issues, they haven't vanished. And the report suggests we should be prepared for potentially negative economic news filtering through, especially as the real effects of those April tariffs start hitting the actual data. We might just be, in the eye of the storm, so to speak.
Okay, so let's zero in on these tariffs then. What's the current situation and what does ING expect, say, short term and maybe longer term?
Right. So the report is pretty clear that despite some back and forth, the overall level of tariffs imposed right now is significantly higher than it was at the start of the year. They do think there might be some near-term breathing room, especially with that 90-day pause on retaliatory tariffs from other countries. However, the expectation is that we will see negative macro news as the direct consequences of April's tariff hikes really start to surface in the numbers. Think of it like the immediate shock might be a bit delayed, but the impact is still coming down the line.
And what's their main scenario, their base case for how these trade tensions play out?
Their core prediction is quite, well, insightful, I think. They see the U.S. primarily experiencing what economists call a supply shock.
Okay.
So imagine a key factory suddenly facing higher costs for imported parts that leads to higher prices, maybe less stuff available, that kind of thing. For the Eurozone, they anticipate more of a demand shock. That's where businesses and consumers might just get more hesitant to spend because of all the trade uncertainty.
The report also makes a pretty firm call, doesn't it? That these U.S. 10% baseline tariffs are likely sticking around for the rest of President Trump's current term. That sounds like a major headwind.
It certainly does. And connecting that to the bigger picture, it suggests this persistent upward pressure on costs for U.S. businesses and ultimately consumers, too. Now, about those reciprocal tariffs, the ones on hold for 90 days, that pause ends after July 9th, remember the report expects some U.S. trading partners might see reductions or even elimination, but probably not until after that July deadline passes.
We also saw that huge jump in U.S. imports in the first quarter of 2025. An absolutely massive number. What drove that?
Yeah, that was striking. It's clear evidence of businesses trying to get ahead of the tariffs, what we call front loading. The annualized rate of import increase was, as you said, huge, 41.3% in Q1. It was really noticeable in things like medicinal and pharmaceutical preparations, think Ireland, a major source there, and also computers and peripherals, where Taiwan saw big increases. Even computer and electronics imports from China rose despite existing tariffs, which suggests companies were really trying to stock up before the new levies hit hard.
But then, counterintuitively, we saw container ship bookings drop sharply in April. How do those two things fit together? Seems contradictory.
Exactly. It does seem that way at first glance. Data from Vision showed a pretty significant year-on-year fall, about 22% in container bookings around mid-April, and bookings from China to the U.S., even bigger drops, like 40–50% range. So this suggests that the front-loading we saw in Q1, well, it might not have been quite as widespread or sustained as maybe first thought. And as a result, ING has significantly cut its forecast for global trade growth this year, 2025, down from 2.5% to just 1.2% year on year. That's a big revision.
So if trade growth is expected to slow that much, why isn't the report predicting an actual, contraction, negative growth.
That's a really important point. It's about the nuances. The report highlights several reasons. Firstly, the U.S. isn't the only destination for global exports. It's huge, obviously, but not everything. So U.S. policy has a big impact, but it's not the whole story. Secondly, there's a statistical effect. Trade in early 2024 was actually pretty low, and we did have that front loading in Q1, which gives a bit of a buffer. We're also seeing some shifts potentially in where countries source goods from moving away from places hit hard by U.S. tariffs. And finally, there are still some temporary tariff exemptions on specific goods, like certain electronics and pharmaceuticals. That helps a bit too.
What about those Section 232 tariffs, the ones on cars, steel, that kind of thing? The 25% ones meant to boost U.S. manufacturing. Are they expected to stay, maybe even get tougher?
That's the assessment, yes. The report suggests these are less likely to be removed for most trading partners. In fact, they think there's a potential for intensification, although maybe with some further tweaks, perhaps even reimbursements to soften the blow a little. Especially with these rising concerns about stagflation,
Yeah.
slow growth plus high inflation in the U.S. And it's worth noting, the list of products potentially facing these Section 232 tariffs is quite long and now includes pharmaceuticals too.
How are the EU's efforts going to negotiate a trade deal with the U.S.? It sounds like a very tricky process.
It really is. The EU has been actively trying to get a deal. They've even delayed their own potential countermeasures and put quite a substantial offer on the table. Things like buying more U.S. LNG and soybeans, even proposing zero tariffs on cars and industrial goods. But reaching an agreement is proving really difficult because of various U.S. demands. Things like big energy purchase commitments and the need for unanimous agreement among all EU members, which is always tough. So if there's no deal by July 8th, the EU is ready to hit back with countermeasures on about $21 billion worth of U.S. exports.
And what's the worst-case scenario here, if these trade talks just collapse?
The pessimistic scenario is, well, pretty concerning. If talks break down and we see widespread retaliation, global trade in goods could actually shrink, potentially by net 0.7% in 2025.
Wow. And even with some recovery expected in 2026, it doesn't sound like we're heading back to the kind of trade growth we saw before all these tariffs started.
That's the general expectation. The forecast for 2026 is for around 2% growth, which is, positive. But that ongoing 10% baseline tariff plus the general reshuffling of global supply chains, it means a full recovery to those pre-tariff growth rates seems unlikely.
Okay, let's pivot slightly. The report mentions the sharp drop in oil prices as something that could potentially soften the blow to the global economy. How does that work?
Yeah, this is an interesting counterpoint. While lower oil prices are generally bad news for oil exporters, obviously,
Right.
they can provide a bit of a tailwind for the rest of the global economy. Cheaper oil helps reduce inflation. It acts as a counterforce to the price increases we might see from tariffs, especially helpful for places like the Eurozone. And it just contributes to the broader trend of disinflation, meaning the rate of price increases slows down.
What triggered this sudden shift in OPEC plus strategy? Why are they suddenly letting prices fall?
Well, the report points to a change in OPEC Plus approach. They seem to be focusing more on defending their market share rather than just propping up prices at all costs. We saw this in their announcement of larger-than-planned supply increases for May and June. This faster return of supply could lead to a bigger oil surplus in 2025, which basically puts a lower floor under prices. The revised forecast for Brent crude in 2025 is now down to US $65 a barrel and just US $59 for the fourth quarter.
Sounds like there might be some internal politics at play within OPEC plus too. Some disagreements, maybe.
That seems to be a key element, yes. Saudi Arabia in particular appears unhappy with some members, like Kazakhstan and Iraq, who've apparently been producing more oil than their quotas allow. So this increase in overall output could also be a way for Saudi Arabia to, let's say, apply some pressure on those overproducers.
But these lower prices must be causing some pain for the producers themselves, surely.
Oh, absolutely. For Saudi Arabia, for example, they reportedly need oil prices nearer US $90 a barrel to balance their budget. So these lower prices will likely widen their deficit. And in the U.S., the shale oil industry generally needs WTI crude around $65 a barrel to make drilling new wells profitable. With WTI trading below $60, we could definitely see a pullback in U.S. drilling activity, which could impact their future oil production growth down the line.
Okay, let's turn to Europe now. It seems like worries about natural gas supplies have eased off a bit. What's the story there?
Yes, there's been a noticeable reduction in anxiety about European gas supply. And that's led to a drop in the TTF price, which is the benchmark for European gas. Part of this is due to stronger flows of liquefied natural gas, LNG, coming into Europe, helped by weaker demand for LNG over in China. Plus, the EU is apparently considering lowering its targets for how much gas needs to be in storage for the winter of 2025-26.
So even though gas storage levels are still a bit below the 5-year average, the overall picture is more stable.
Yeah, storage is currently over 41% full compared to a 5-year average closer to 51%, so still a bit lower. But the combination of more LNG, potentially lower targets, and more normal pricing for future deliveries has led ING to revise down their 2025 TTF forecast to EUR 39 per megawatt hour. Although they note some reluctance to cut it even further because the market is still considered relatively tight, still vulnerable to unexpected shocks.
Let's talk central banks. How are they likely to react to all this? President Trump has been quite vocal about wanting the Fed to cut interest rates. What's the Fed's likely move?
The report suggests the Fed is probably going to adopt a wait-and-see approach for now. Yes, they're facing political pressure to cut rates, but their main focus will likely be on figuring out how these tariffs are actually impacting inflation, especially since the U.S. labor market is still pretty strong. Fed Chair Powell has really emphasized keeping long-term inflation expectations anchored, stable, which suggests they'll be cautious, not make any sudden moves.
But we are seeing consumer and business confidence declining in the U.S. Doesn't that suggest a need for some kind of stimulus?
It does, and the report points this out. This drop in confidence down to levels often seen during recessions really underlines the urgency for either, trade deals to get done quickly or maybe tax cuts,
Yeah.
something to try and head off a stagflationary slowdown. But despite that weakening sentiment, the current expectation is still that the Fed will start cutting rates later in 2025, maybe beginning in July or perhaps with a larger, say, 50 basis point cut in September. They're looking for about 100 basis points or 1 percentage point of easing in the second half of the year.
What about the European Central Bank?
Yeah.
They already cut rates back in April. Are more cuts expected there?
Yes, the expectation is definitely for the ECB to continue cutting rates. Probably 2 more cuts are anticipated. This is largely driven by those ongoing trade tensions we talked about, plus the drop in energy prices and also a stronger euro. All these things add to disinflationary pressures in the Eurozone. And recent comments from ECB President Lagarde hinting about being ready and agile also suggest they're open to easing policy further.
And quickly, the Bank of England and Bank of Japan. What's the thinking there?
The Bank of England is expected to stick with gradual quarterly rate cuts. That's actually slower than financial markets seem to expect. Their more cautious stance probably reflects the UK being a bit less directly hit by US tariffs, but also maybe some underlying concerns about headline inflation picking up again later in the year. As for the Bank of Japan, they've decided to hold rates steady for now, mostly because there's just so much uncertainty around US trade policy and what it means for Japan's growth. However, there's a possibility the BOJ could raise rates once a U.S.-Japan trade agreement is actually finalized, maybe even as early as July.
Okay, let's zoom out a bit and look at how these global trends might impact different regions. Starting with the U.S., what's the quick summary?
For the U.S., the report sees a rebound in GDP growth in the second quarter, mostly if that big import surge reverses. But the weaker confidence data points towards a pretty sharp slowdown in the second half of 2025.
And the Eurozone. Key takeaways.
Growth there is expected to pretty much stagnate from Q2 onwards. But those lower energy prices, plus the German infrastructure package, though the main impact is probably 2026, should offer some support.
China, given its role in trade.
Yeah, the expectation is that the April data from China will show the biggest hit so far to its U.S.-bound exports because of the tariffs. And in response, the People's Bank of China, the PBOC, is expected to ease monetary policy later in the year.
What about the rest of Asia?
Generally, downward revisions to GDP growth forecasts across the region. That's due to the direct hit from tariffs on their exports, plus the indirect effects via a slower China. South Korea is actually projected to have the lowest growth in Asia in 2025, while India is expected to be a relative outperformer.
Moving over to Central and Eastern Europe, any big differences there?
Yes, definitely seeing a widening divergence. Poland looks set to remain quite strong. The Czech Republic is surprisingly positive, actually. But Hungary and Romania seem to be growing slower than expected, and Poland is expected to start easing monetary policy.
And the CIS 4 countries, Azerbaijan, Armenia, Kazakhstan, Uzbekistan.
For them, it's mainly higher inflation risks and those weaker oil prices that are leading to adjustments. Uzbekistan's benefiting from higher gold prices, though. But expectations for Kazakhstan and Azerbaijan have been downgraded because of the lower oil price outlook.
Finally, the UK seems very focused on the EU relationship.
That's a key point in the report, yeah. The UK is really relying on resetting its trade ties with the EU to help strengthen its public finances, perhaps even more so than potential deals with India or the US.
Let's just touch quickly on currency and bond markets.
Mm-hmm.
The US dollar's rebound seems a bit lackluster, maybe, despite stocks and bonds recovering somewhat. Why is that?
Yeah, the dollar's rebound has been a bit underwhelming. It could be down to that ongoing uncertainty about U.S. policy, maybe expectations that investors are increasing their FX hedges on U.S. assets, sort of betting against the dollar. The report suggests a near-term range for UOSD of about 1.1 to 1.15.
And the bond market, described as Jekyll and Hyde. What does that mean?
Yeah. It reflects those conflicting forces we've been talking about. Initially, you might see lower U.S. Treasury yields because of worries about a potential recession, a flight to safety. But then, later in the year, there's this risk of a Sell America Inc. scenario where investors lose confidence in the U.S. economy and the dollar, and that could actually push bond yields higher again. Two very different possibilities.
Okay, so bringing it all together, the global economy is clearly facing some pretty significant headwinds, largely from these trade tensions. The impact's going to vary a lot by region, and central banks are all trying to figure out their own path through it. While lower oil prices offer some relief, that overall sense of uncertainty remains really high.
Absolutely. That initial analogy, the deer in the headlights, it really does seem to capture the current mood, doesn't it? And understanding these underlying forces, well, that's the essential first step if you're trying to navigate this period.
Exactly. And on that note, here's something for you, the listener, to really think about. Given these conflicting signals we've discussed, the potential for both recessionary pressures and maybe resurgent inflation, how should individuals actually prepare for the rest of 2025 and looking beyond? What are the most critical indicators you should be watching most closely to make informed decisions in this really complex and frankly uncertain environment? Definitely some food for thought there.